hey, is this something that's going to pique my interest? Oh, I'm just completely out. Something else you need to pay attention to. Wow, I'm actually quite surprised on the revenue site. Oh, this looks cheap. I'm going to go buy it. Hey guys, today we're going to be looking at PayPal. So PayPal, everybody knows, I assume everybody uses it. It's a super platform. It's anytime that I buy something from, whether it be eBay, something from Alibaba, something from some obscure website, if they don't have PayPal, I know eBay and Alibaba do, if the others don't have PayPal, I'm probably not using it because they back me so well. The question becomes, is this a good price to pay for PayPal? And we're going to look at that today. So I'm just going to scroll down here and look at a few different metrics, and this is just a screening process. So if you're new to this is a screening process. I look at different metrics and say, hey, is this something that's going to pique my interest? And if it doesn't, then I'm just going to move on very quickly. But first thing I notice is the market cap and enterprise value are very different. The difference between the two is the debt. And right now, that's a big number. Now, it doesn't necessarily make me say, oh, I'm just completely out. No, I'm going to dig a little bit deeper. Maybe there's a reason for it. And when we look at the 8 pillars and the pillars that I put in myself, we'll check it out. Let's see. PE is a little bit high. I love the gross profit margin being 50%. Now, the bottom line margin of 8.8, that's a little lower than I would have liked, but we'll get on to it. They don't pay a dividend, which is perfectly fine with me. Let's go to the 8 pillars. So these are the pillars that we generate, but also you can see here, guys, I have my pillars and you can have your pillars. You actually would come up here to tools, click pillar screener, and it's going to give you trillions of different combinations that you can have. And this is something that if you want the software, you will have this as a part of it. For the $7 for 7 days or $29 a month right now, that number is going up. But I put in 5-year PE greater than 25. Less than 25. The EMPE is less than 22.5, so I was a little bit more lax on that one. 5-year ROIC, it was a little more aggressive on this. I wanted it greater than 12, it's 9.5. See, it's a check for everything money, but it's not for me. 5-year free cash flow growth, I want to see it. Revenue growth, I want to see it. They don't pay a dividend. You notice, dividend. That's not in the everything money pillars. So that's something that I like to see. I want to get a dividend. This company doesn't pay a dividend. It's just a little bit of a screening process that you can throw in there. Let's go to the income statement. So let's see here. The thing that always gets me with these tech companies, especially going through 2020, was did they have big spikes in revenue throughout COVID? And is that going to be something that's sustainable? So let's go back 10 years, 2014, 9 years, $8 billion in revenue, and they just consistently grew. Not astronomical growth, but they grew $1 billion or $2 billion a year. All of a sudden, 2019 happens, and they grew about $3 billion, $3 or $4 billion, and now $2 billion. So you notice that the jumps were $1 to $2 billion. These 2 years here, they had a little bit more growth, and now it's kind of sustaining around that $2 billion. So my question to myself is, all right, are they going to be able to sustain around this number, or is this year going to come in at 26, then maybe 25, then we start building back up 26, 27, etc. So that's a question that I need to ask myself, and something that when I'm trying to price this thing for myself, I got to make sure it's a realistic expectation. Now, when we come to the net income, you notice here, you had 2 years, 2020 and 2021, of $4.2 billion. They never did $4.2 billion before that, and currently they came right back to their 2019 level. So their net income is coming back to reality. So I can't base it off of this 5-year average. This 5-year average is probably a little bit lower if you slash these two out. Slash those in half, your 5-year average significantly drops. So something else you need to pay attention to. It's not just going in there and saying, oh, this looks cheap, I'm going to go buy it. No, there's things in there that you need to say, oh, maybe this isn't going to work out the way I want it to. Now, share buybacks. They have been buying back shares, but not super aggressively. Nothing significantly stands out to me. I probably like that they've been buying back shares the last couple of years, but it's nothing that makes me excited or not excited. Let's go to the cash flow statement and see their free cash flow, because I'm expecting that their free cash flow significantly jumped like their net income did. So here, our 5-year average free cash flow, this is not on any other software. We do the math for you. So let's go $2.5 billion, let's call it $2 billion, 4.6, 3.3, 5 billion, 5.43, 5.11. So I would venture to say that their free cash flow is going to trickle back towards this 3 or 4 level, based on the jumps that I saw in 2020, 2021. Now, they have sustained it in 2022, but do I think it's sustainable? I don't know. That's a question that you need to ask yourself. So again, let's see what the analysts say. Remember, guys, when it comes to analysts, and I've said this a lot in videos that we've done lately, before Silicon Valley Bank went down, there was not one sell rating on Silicon Valley Bank. Everything was a buy or neutral. So take what analysts say with a grain of salt, but use them for a little bit of guidance if you're looking out 10, 15 years, but also pay attention to the number. You have 49 analysts that are looking out to the end of 2023, and by the end of 2026, you have 5 people there. So that to me tells me that there's a lot of uncertainty of whether revenue, cash flow, profit is going to sustain over that long period of time. So let's see. Into 2026, we see pretty good earnings per share growth. Not a super high return on invested capital, so I'm actually a little bit surprised here, but pretty good earnings growth. Now, on the revenue side, wow, I'm actually quite surprised on the revenue side too. I didn't think it would grow that much. I'm probably going to guess around 8% average, something like that. So let's go to Stock Analyzer tool. And this is the most powerful part of the software. So if you're looking to get this software, pay attention to this. This is the tool that I use the most. I use this on my phone. I use it on my computer. I use it on my iPad. I use this all the time. I take screenshots and send it back and forth with Paul and an analyst that works for us. I use this screener all the time. You can use it. Let me walk you through it. So looking at revenue, you can make 3 different assumptions: low, middle, and high. However many years you want to go out. I'm going to go out a decade. Or if you wanted to, you can do 1 assumption. But for me, I want to do 3 assumptions. So revenue growth over the next decade. What do I have to pay today to get the return that I want? So on the revenue side, I'm going to go with 5, 7, and 9. I think 7's probably that sweet spot range, but let's say that they don't crush it. 5% on that low end. Say they crush it, 9% on that high end. Profit margin. I'm going to go with 11, 13, and 15. They, over the last 10 years, including 2020 and 2021, they've done 13.6%. So for them to do 15% over the next decade is a lot. I think they'll probably fall in that 13% range. If they don't do very well or things really pull back, maybe it'll be 11%. But this is on average over the next decade. Free cash flow margin is much, much higher. So I'm going to go with 18, 20, and 22. For the PE, I'm going to go 16, 17, and 18. They are a very kind of modish brand. For security of online purchases, I go to them. I don't go to Apple Pay. I don't go to Amazon Pay. I go to PayPal. So for my personal opinion and what my friends do, we use them. We also use Venmo a lot, owned by PayPal. So the PE, I know that I'm looking at this, or you're looking at this saying, how are you going to go with 16, 17, and 18 PE if the current PE is 34? Well, I don't think that they should be at a 34 PE right now. So we'll see. Price to free cash flow, I'm going to put in the same numbers. And for my return, I'm going to do 10% return, 12% return, and a 14% return. So it's going to spit out 6 numbers. It's going to spit out numbers that I need to pay today to get these return levels I want, okay? And you can see that it's on my watch list at $55. So just another tidbit of our software, when you get stocks on your watch list that hit $55, in this case of PayPal, you're going to get an email, you're going to get a text, you're going to get an alert on the app. Everything is going to tell you that it hit. All right. So right now, as multiple of earnings, I'm looking anywhere from $47 to $70. And as from my discounted cash flow model, 77 to 102. Question becomes, which one is right? Which one is sustainable? What levels are we sitting at? I personally think it's somewhere in this range. And the reason that I'm at $55 is I want to buy this thing less than these prices. Personally, I want to get this thing around $40, $45, $50, something like that. So that's PayPal right now. Make your own choices, join the software, talk to other people about it. This is a hot topic of conversation up in our community. You guys have a great day.